Today, let's talk about a better bet than shorting this market. Because let's face it, if you've been trying to short this market for the last 2 years, well, it's been a very, very difficult task. As the market's pressing into new high ground, well, that's not necessarily a bearish thing. Yeah, we see divergences forming, and the last times we've seen this happen, we've seen the market come off, and that can very well still happen. You can even see back month versus front month volatility. We're starting to get very extended, as we mentioned in prior videos, and typically when we get into these levels, you see consolidations in the markets or subtle pullbacks. But what would be the better bet than shorting the market if you're not willing to do that? Well, let's take a look at energy because market tops, energy can be a top performer. So if I go ahead and show this chart, but instead I put XLE down here instead of the SPX, what do you notice? Well, when back month versus front month volatility gets up into these readings, energy has seen some strength and some pops in recent trade. And as the market's been pulling in here on XLE, we are rather extended. Now, is that going to play out the same exact way? No, not necessarily. So let's get a little bit deeper than that. WTIC saw a pretty big bullish day today, up 2.7%. It is a bunch of series of lower highs, and we're kind of matching lows here in a bearish trend. So yeah, we might be just seeing a little pop, but overall, the price action here is getting rather tight, looking to see if it breaks up or breaks to the downside in the near term. Now, why is this important? Well, because oil relative to energy, we'll take a look at some correlation charts down here on different time frames. Basically, it goes from 15 days, 30 days, and then gets larger as we move down 90, 120, and 180 days. And what you'll notice here, see this little middle line in all of these time frames, is that the correlation is rather positive, which means what? It means that when there's a positive correlation between oil and energy, they typically move in hand. So if energy goes up or if oil goes up, energy will go up. And now in recent, last few months or so, you can see that these longer term averages, they spend most of their time in positive correlation, but right now they don't really have a correlation between the two. If you look at the very near term, the 15-day correlation, you can see that there is a positive state. And we just saw oil see a little bit of a spike here. And then energy today, we saw the day down, practically unchanged overall. The 10-year yield is also something to pay attention to, as we saw a nice reversal on the 10-year yield today as we came into a little low here, and then we closed at the high of the trading session. So is this just a pullback to come potentially back up? Well, as this has been coming off, obviously, bonds saw a nice little rally here from this diamond formation pattern, which has a measured move. We measured on the breakout or right before the breakout to and around that 95 area, and we came close to that, and we still may get up there. But why is this important? Well, because the 10-year yield is also very important to watch next to oil, because oil typically leads the 10-year yield. So when you see oil come off, the 10-year yield followed there shortly thereafter. When oil found its bottom here in September, guess what? The 10-year yield found its bottom there shortly thereafter too. And as oil has been going down, right, there's been a divergence between these two, but yet we did finally catch the downside. So the reason I bring this up is because if oil does want to break out and the 10-year yield wants to follow back up suit to see a little bit of a pop higher, that could put pressure on various equities, which we've seen happen in the past. For example, if you look at the 10-year yield in the US dollar, when they both went down in unison, here from Mayish to September, Octoberish area, what did the S&P 500 do? It went up. On the flip side of that, when the dollar and the 10-year yield rose, what did the S&P 500 do? It flattened out and kind of went down. Now, in a recent trade, these correlations have been slightly breaking, right? The dollar's been going up, the 10-year yield, and the S&P 500 all hand in hand. And that could be due to many different factors. Could be some geopolitical risk, could be the presidential election, stuff that's been priced in for a bunch of reasons. But I do expect the correlations to come back into play in the near future. Now, another thing that I like to look at is the relative strength line between energy and the S&P 500. So basically, in short, when this line goes up, it means energy, XLE, I'm using as the proxy, is outperforming the S&P 500. And when that happens, it's not necessarily a good sign for the S&P 500. As you can see here, when it went up, the S&P 500 went down. When this line went up, the S&P 500 went down. When this went up, S&P 500 down. And in recent trade, you can see it's been going down and the S&P 500 has been going up. So the thought here is if energy outperforms the S&P 500, one, that'd be good to have some energy in your portfolio, but also it could potentially mean that the S&P 500 comes off a little bit. Another bearish sign that's been taking place here in the market is the put to call ratio has been coming off here, which can tend to mean some very bullish activity. And if we look at the 10-day moving average of the put to call ratio, the last couple of times that we've gotten down into these areas, we did see the market correct a bit as the line started to progress higher. So we'll see here if this wants to come in still a little bit and then potentially turn up thereafter. But just note that the last times we've gotten these readings on the 10-day moving average on this put to call ratio, when it started upticking, we did go through some bearish activity in the markets. Now, the reason why I say, don't necessarily be really bearish here in the market is because we are still above a gamma flip line. And this is where dealers look to buy the dip and sell the rip. Traders are reaching out to 6,100, and that is still a viable opportunity. So if the S&P 500 wants to make its way up into there, it doesn't necessarily mean that the energy sector has to fall down. It can move up in unison, which is why I say stuff like it might be a better bet than shorting the current bull market, right? You have to come to the conclusion yourself and manage risk as you see fit, obviously. If we take a look at the trend changer, we're above the 5-day moving average and the SPY and the Qs, but IWM did come off a little bit today. It's starting to roll over a bit, so it's a time to be cautious, time to, just be prepared that this can mark turning points. But if we start getting back above it, that'd be a positive sign. The DIA is right on that 5-day moving average, so it says caution over here. And then biotech also came off. It's rather flat right here too. And then semiconductors doesn't look all too bad as it's been consolidating sideways, and the 5-day moving average has been consolidating sideways to tiny turning up here. So if semiconductors can hold up, hey, perhaps we start to see some love in that sector, which we have not been really seeing. If we take a look at the S&P 500 on the 15-minute time frame, I'm using SPY. We're pretty much unchanged overall. We've been going sideways. We have a wide open weekly expected move still. Tomorrow's daily implied move is right over here and right over here. Remember, if you think of this in terms of a distribution curve, 68% of the times, it will close within those levels. So those would be the levels I'm watching for tomorrow's trade. If you look at the Qs did reach up near its weekly expected move today's trading session. If you want these levels on your screen, just screenshot them and go ahead and put these levels on. But these are the implied levels to watch out for tomorrow. The Qs have been seeing some really nice strength as we discussed on the prior video. You can see though, if we look after the market close in the aftermarket, we did tag into the upper weekly expected move already for Qs. So if the Qs is going to doodle around here, it could be hard for the S&P 500 to really gain momentum up here. It's going to need some other players to play, and we got to think about what players those could potentially be. Well, let's take a look at the mega cap names and see where they currently are. Well, Apple reached into its upper implied move for the week on day 2, so we are up there. Microsoft has already tagged into its upper implied move there too as well. So some of the bigger market cap names have already reached up into these levels. We have Nvidia that still has the opportunity to try to reach up into these areas, and that would be a bullish sign for the overall markets. Google did come very close, but we kind of started backing off there. So there was an untagged level. Amazon's not too far away there. And then Meta was the big outperformer today. It was looking like it was setting up for a potential fade opportunity intraday. They did get some news about something about, I think, content restrictions they were going too hard with, and that might be changing, and the market really, really liked that. So this right here is a 2 standard deviation move, a weekly move, right, in the price of Meta already. And if you look at it from a daily time frame, it was a daily breakout of this kind of volatility expansion pattern over here. And if you look at Tesla, would be another one to watch that's still wide open. It's slightly up on the week. We saw a nice start to the week, and it's kind of consolidating here overall. So if Tesla wants to find some strength, and if Nvidia wants to find some strength, those could be areas to pay attention to if we're going to try to get the SPYs up. If we're going to try to get the SPY up into and around the upper weekly expected. So once again, a better bet than shorting this market. Clearly, it's a bull market. And yes, if you short the market, you can potentially get some gains. One way of approaching it, if you do not want to short, is looking at something like XLE, right? Energy names. There's other various individual equities that are within the XLE. Obviously, you can look at other ETFs like drill. You could there's so many different ones. XOP, right? There's so many different various equities, and if you don't want to do that, that's totally fine too as well. You can still look at some of these other large market cap names that have been performing. And when things start to change, when we start getting into negative gamma territory, when these start to light up red, it would be the time to really take your foot off the brake. And sometimes a better bet than shorting this bull market might just be being in a larger cash position as well. Hope that helps out. See you on the next.